But these countries, started giving balance of payments deficits, which means it created problems, ability to pay. The first sign came from Mexico. It basically told them, I don't remember the number, it's here. It wanted foreign banks to forgive its $68 billion in loans. Now, $68 billion is not much money today for Mexico. But in 1982, that was some real money. And if you uh, calculate the GDP in 1982, divide by that, it was a big percentage. Okay, and this is in 1987. Citicorp had almost $3 billion loans to Mexico, but they also had loan loss reserves for developing country loans over $3 billion. That means their estimate of how much they think they're going to have to eat up or the haircut that they're going to get. That was a big problem. And this was actually eventually solved by the intervention of United States Treasury. The Secretary of Treasury those days was a guy named Brady. That was the guy who was actually shot during Reagan's assassination attempt on Reagan. Uh, U.S. basically put all these things together, and they said we're going to issue bonds that are kind of guaranteed by the U.S. government. Those were called Brady bonds, and they kind of saved it like that. But early 80s, the international monetary markets were not that integrated yet. So it didn't create contagion issues. If Citibank had went down, it probably wasn't had gone down. It probably wouldn't have affected Deutsche Bank that much because Deutsche Bank didn't lend too much money to military dictatorships. Okay, but now things are a little bit different. You can read about those Brady bonds. The next big crisis was late 90s, the so-called Asian crisis. The leading causes is probably what happened to Japan first. In Japan, 1990s is called the lost decade. It was a decade where the Nikkei stock index went from about 39,000 to around 8,000. This is in Japanese yen terms. In 1989, $1 got you 80 yen. In 1997, $1 got you about 150 yen. That means in dollar terms, uh, Japanese stocks lost about 90% of their value. Some of it was collapse of the real estate bubble, and Japan being a country where real estate is rather valuable. It's an island country, and a lot of uh, that island is also mountainous. And a lot of companies had excess cash during their good years in '80s, and they invested those monies into real estate because they didn't want to put it back into U.S. They did some. In fact, they ended up buying half of Manhattan later on in the '90s. But when the values of those real estates holdings went down, Japanese firms got in trouble. If Japan is in trouble, your close trading partners are going to get in trouble too, right? Who are those guys? Taiwan, South Korea, you know, Thailand, Indonesia, what have you. But the trigger kind of started in South Korea, even though underlying cause may have been slowdown of Japanese economy. Uh, there was an interesting, it's still like that too, but it's not too bad. Uh, just like the Japanese economy, Japanese industrial organization in 70s, 80s, and early 90s, companies are kind of centered around some major firm, industrial groups. In Japan, these were typically banks. For example, there was a Bank of Tokyo Mitsubishi, was effectively the Mitsubishi group of companies. And, Fuji, it was centered around Fuji Bank. You know, those days, the photograph was important. So Fujifilm actually was one of those bigger companies, so on and so forth. In South Korea, they're centered around groups called chobos. These were like, Samsung, Daewoo, what have you. And these were really, really corrupt. Uh, basically, all decisions were made in the name of the chobol itself. Nobody particularly cared about the individual companies. But a lot of the growth of Korea in 70s, 80s, early 90s were financed by borrowing in US dollar terms. Since South Korea at that time, it was also kind of a dictatorship as well, and close ally of US. We still have a lot of soldiers stationed there. A lot of US banks and even individual investors didn't think twice about lending money to these guys. They were like the second coming of Japan, right? But these were in US dollar terms. But once the economy started slowing down, at some point, the Korean currency had to crash. And it did. The Korean won. And if you're a company with US dollar loans and some or most of your revenues are in Korean won terms, you got a big problem. You're short dollars and dollars going up. And that created a lot of defaulted loans. And I mean, it pretty much created problems in American banking, but it wasn't as big as the Latin American debt crisis. So no bank actually went down. But the Korean economy only started coming back up because of that big devaluation. That meant Korean products were now cheaper, but it took them a while. The biggest of these crises was after the financial crisis in 2008. Uh, First of all, there was what we call a credit crunch, a global credit crunch. If you were Apple and you needed new cash, it wasn't that much of a problem for you to get new loans. But if you were a smaller company, people simply started staying away. Getting mortgages weren't that easy anymore. So that's why the economy crashed. When the economy crashes, there are a lot of defaults. Any of you guys watched a movie called, not Margin Call, the one that Brad Pitt also plays, The Big Short? Okay. There were these mortgage-backed securities that were rated AA before the crash, and these are backed by mortgages. And those guys, some of those guys went down to, the thing with the mortgage-backed securities, it's backed by the mortgage payments. If somebody defaults, their property is foreclosed on. So you're carrying the risk of the deflation of the real estate values. In places like Florida, that deflation was about 50%. In fact, about 2 years after that crash, I went to visit a professor in Florida State with my co-author, and he took us to some neighborhoods in Tallahassee. I'm not talking about inner city. These were new developments. That these were $500,000 houses, ghost town. People simply threw the keys in and left because they borrowed at relatively high rates. They couldn't afford the payments anymore. Whole developments were completely gone down. But if you're double A rated, you know, those things should not go down to 50 cents on the dollar. But everything real estate related were considered toxic assets. I wish I had ability to invest into those bonds those days. Unfortunately, the only money I had was in my equivalent of 401k, and you couldn't invest into those assets. I wish I did, because about 3 years after those crises, stuff you bought at 30, 40 cents were trading over 120, $150. Sometimes markets overreact like that. Nobody wanted to be caught with those assets in their balance sheets. And because of that, we had three big investment banks gone down. Bear Stearns first, uh, Lehman Brothers, and these are investment banks with 150, 200-year histories. Then the biggest of all, Merrill Lynch went down. Okay, the so-called, the nickname of Merrill Lynch was the Thundering Herd. Why? Because they built all these